Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Rausan Pereira. The Department of Economic Affairs fears significant default from large non-banking finance companies and housing finance companies in the next 6 weeks if no additional liquidity support is provided to these firms, according to media reports. The DEA, in a letter to the Ministry of Corporate Affairs, described the financial situation as still fragile when discussing the financial stability impact of the infrastructure leasing and Financial Service Limited's default, according to news website Money Control. A string of defaults at IL&FS have triggered sharp falls in Indian stock and debt markets amid fears of contagion within the rest of the country's financial sector. Last month, the government took control of IL&FS to protect the financial system and markets from potential collapse and replaced its board. The new board submitted a plan to revive the debt-laden firm this week. Nearly 2 trillion rupees of NBFC and HFC debt is due for redemption by the end of December, the DA said in its letter. It said that it estimates a funding gap of as much as 1 trillion rupees by the end of the year. On this edition of The Big Picture, we will analyze what ails the NBFCs. Joining me on the program today are Nitin Desai, former Chief Economic Advisor to the Government of India; Subhomoy Bhattacharjee, Consulting Editor of the Business Standard; Ajay, former Secretary, Ministry of Commerce and Industry; and we are also joined by Sanjeev, Gupta, Chairman, Managing Committee, PhD Chamber of Commerce and Industry. Thank you to all my guests for joining me on this edition of The Big Picture. Subhomoy, I'd like to begin the program with you. Let's first try and put into perspective what NBFCs are and what are the different types, really.
Right. So, NBFCs, as the RBI defines, broadly would be of two types. One is the deposit taking and one is the non-deposit taking. The non-deposit taking are typically the big ones. For instance, IL&FS, about which you refer to, would be at non-deposit taking ones. And these are the big ones. What do? They essentially take loan or from the market or from the banks and then use it for projects or other purposes. They could even lend for housing, they could lend for a building, for a shop, for markets, anything, or they could lend for infrastructure projects, depending on what is the typical business activity of an NBFC. The problem that's coming up is that in the contagion of the IL&FS, which was essentially doing infrastructure funding, banks are starting to get concerned about whether the NBFC's this business is viable and whether that would mean that should the banks start withdrawing or calling back the loans they've taken. How do the banks deal with NBFCs? Banks deal with NBFCs typically three-way. They buy into the commercial papers which NBFCs float. They can give loan to the NBFCs or they could refinance them. The problem is that NBFCs form a significant percentage. It's almost 45% of the entire banking sector's exposure, credit to the economy, goes to the NBFCs. So NBFCs therefore play a very major role. In fact, you can say like where the banks stop their activity, the NBFCs begin and go up right down to the retail level. Now, if the NBFCs seize up, then that means a severe problem for the economy.
Right.
What you are discussing right now is that whether there's that situation coming up. The letter from the Department of Economic Affairs to the Corporate Affairs Ministry says that because the banks, and banks, remember, already have a problem of large debt overhang on their balance sheet. So would the banks start becoming more cautious, and is there a deficit?
Right.
There is a deficit, of course. Incidentally, the RBI figure as of end of October shows that there is about 1 trillion deficit in the market. In August, it wasn't so. In August, it wasn't so. It has turned into deficit now. Now, whether this deficit would get aggravated because there is a large amount of commercial papers of these NBFCs coming up for redemption.
Absolutely.
Is what is concerning all of us.
Absolutely. Mr. Dua, that having been said, let's now try and understand what is the major difference between banks and NBFCs.
I would think the differences originally were when NBFCs were allowed. It was a very clear demarcation whether they could accept deposits or they could not. Initially, no NBFC was allowed to accept deposit. It's only later on over time that they have been allowed to do so. But more important difference is that while for an NBFC, there is no need for a license from the Reserve Bank of India. All banking institutions require a license from the RBI, which, as we know, it is not easy to obtain. Second difference is the kind of prescriptions on cash holding, liquidity, CRR, SLR, which are prescribed by the RBI on the banks. Those statutory ratios do not apply to NBFCs, which means that while RBI is the supreme, in a way, regulator, it's given them much more elbow room. Finally, I would say amongst the major differences is the credit or the deposits made in banks by any depositor is covered by the Deposit and Insurance Credit Fund. There is no such guarantee available from DICGC to the depositors in the deposit-taking NBFCs.
Right.
These are the legal kind of changes or the legal differences. But from the Reserve Bank, what's required instead of a license is a certificate of registration, which is much easier to obtain, and the compliance requirements are fewer. That's in terms of definition and the procedure. By and large, in terms of activities, the banks have been dealing with the organized sector, and the NBFCs were meant to deal with the unorganized and the smaller enterprises. But over time, this difference has been breaching, particularly in terms of lending, the lending operations by the dozen odd large NBFCs, which includes NBFCs like the Car Finance Corporation,
Right.
or like the Rural Electrification Corporation in the government fold, Sriram Transport, or Larsen and Toubro's financial company, Mahindra's financial company, or Tata's. So none of them have licenses, or Mahindra has one under the Kotak Mahindra brand. Others have been doing a range of financial services, but
Right. Let me now go across to Mr. Desai. Mr. Desai, what is the fund source really as far as these NBFCs are concerned?
See, basically, the fund flow came mainly from the financial institutions are the major investors. I think about banks are about a little less than half, then mutual funds. Remember this, there's a lot of inflow into mutual funds, particularly debt funds, and those people are major buyers of these instruments. I'm told about a third of the balance sheet of the NBFC is financed by these, and about nearly 19-20% by insurance companies. These three account for 96-97% of the balance sheet of the NBFCs. That's where the money was coming from. The problem that has arisen now is basically a mismatch of term structures. These people are basically lending long, particularly the housing finance companies. They are lending long. And for quite some time, they could get relatively long-term money against bonds and even against term loans from financial institutions. But for the past few years, that has come down because banks have become much more reluctant. So they've had to turn over things, borrow on a shorter term basis, lend on a longer term basis, which means they always face this perpetual risk of liquidity problems, which is, I hope right now what we have is a liquidity problem, not a solvency problem. That, what you mentioned, that $1 trillion which are due to be paid. In fact, one major headache is going to come up in next week, when I think on one day they have to repay about 100 billion. And so we'll soon know within a few days, actually on Monday, as to how things are likely to be. Reserve Bank's defense is that why are you picking on NBFCs? We are doing open market operations. We've done a very generous one in October. We are planning another generous one in November. That will pump money into the system. But who is it going to pump money into? Mostly, basically, it will get in the way it works. It will end up in banks, OMOs, open market operations. Are the banks going to online? And one more thing I wanted to mention. There's a very curious upsurge in bank lending to NBFCs between September and March of last year. A very peculiar, huge upsurge. And in fact, I understand that the Reserve Bank got a little worried by that and sort of ask them to slow it. One final thought I wanted to give is that there is a regulatory issue here as to how these people are quite substantial. They're not small, these NBFCs. And do we have an adequate system of regulating their activities,
Right.
things like capital adequacy, etc. You see, so this is probably the source of the problem. My hope is that it's only a liquidity problem, not a solvency problem.
One. Yeah, right. Let me go across to Sanjeev Gupta now. Mr. Gupta, what is the size and the scale really of the NBFC industry?
Said NBFC industry actually almost is the shadow banking, and with around 115,000 odd NBFCs comprising of both the deposit taking and the non-deposit taking, it comprises of a very large chunk. In fact, let me start from saying that the total loans to NBFC of around 5.46 trillion rupees is actually 20% of the total loan credit itself, the banking credit itself, which is around 27 trillion, let's say as on the 30th of October. And frankly, if you see the year-on-year rise in the total banking credit, the total credit that bank has given is 2.6%. Whereas the loan to the amount of funds lent to NBFC is risen by 41%. So I think the amount that has gone to NBFC is not small. So I think the point to see is where is the problem? And I think some of us are rightly trying to analyze that. I think the main problem that has come through is that the entire banking system, the way it was directly lending to the MSME or to the retail segment, has actually gone down. So while the shadow exists, the main character itself has actually stopped almost. And that is, I think, what's causing the problem. So that's, I think, the very, very, very important thing. And to top it up, if you see what has got lost is the perception. The NBFCs were, probably raising money not only from the banks, which somebody has rightly pointed out, around 45% or whatever, but at the same time, they have actually used a lot of their own, stocks and other things to place pledge. As the perception got lost, the values got eroded, and the triggers of these stocks to be sold further caused a lot of pressure on the NBFCs, and in the whole process, the entire market and the capability to raise money from thereupon has actually been eroded. So the problem further got compounded in that sense. And I think we should clearly come back to see that why is the government concerned? Because the festive season is around the corner, and there is this threat of around 2 trillion rupees that we are talking about hanging on the head that would actually come to be evoked further on if it is not timely checked. So I think some of the remedial measures, I'll take a moment here to explain from my side, are actually that, we can go to a very important source, though there can be a lot of solutions. One important source remains the non-resident Indians who can be tapped, and it will solve the problem. If we take it as bonds, it will solve the problem of raising the tier 1 capital for the banks, which can further improve the liquidity on one hand, and on the second hand, actually address the problem. So the liquidity gets addressed there. And on the other hand, the dollar, which is actually causing a shadow on the rupee, and the rupee weakening, can actually also be addressed by these dollars coming in.
All right, let me go across. Let me bring in the others as well. Let me bring in the others as well into the picture, because Subhomoy doesn't seem to agree with your theory there as far as liquidity is concerned. Is that workable, Subhomoy?
No, I don't quite subscribe to that NRI bond thing for the NBFC, for the simple reason that there's another problem here. Not only is there a problem of liquidity, which Dr. Desai and Mr. Ajay have both explained, the problem is also about the weak capital structure of many of these NBFCs. They are frankly very thinly capitalized. Their promoters do not put adequate skin in the game for quite a few of them. And it's time now, not just if RBI is going to get nudge banks, or if our finance minister is going to nudge banks to lend them more, it's also necessary that the promoters of these companies also put in more capital to make their leverage ratio come down. It is very important now. It's the same problem which had affected us. Remember, these are held by somebody or the other, some companies. And if I look at the capital structure of these companies, their underlying tier 1 capital and others, it's very, very thinly capitalized. The banks have borne the brunt of the message of saying that they are thinly capitalized. The NBFCs are also. And many of them in fact, IL&FS's big problem is that it's very thinly leveraged, thinly capitalized. And the same problem is there with other NBFCs, and that should not be lost sight of. So before we rush to help them out, it will have to be done possibly. They should be forced to bring more capital on the table. I think that's very essential at this stage. Otherwise, we would miss a major chance of reforming the structure of these NBFCs.
All right. Yeah. Yes, Mr. Gupta, I can see you putting up your hand there. Go ahead. I'm coming to you, Mr. Dua, after that.
A moment here. Yeah. Sorry, Shubhendu, you probably misunderstood me. You misunderstood me. I was not saying that we raised this foreign NRI sourced capital directly on the balance sheets of the NBFC. I was saying that we will raise it on the balance sheets of our public sector banks so that actually it increases their tier 1 capital, which is what I said. And in the process, two things will happen. That this money, which will come from the offshore sources in the dollar coming through into the country, will actually not only help liquidity, but also help the appreciating of the rupee in that sense. So I was not using at all their balance sheet, and I'm not actually in favor of, supporting the, or rather I would say just doing a short-cut measure to any of the NBFC problems that we are facing in this country. I agree that it will have to be a long-term systematic measure. Otherwise, it will be just a band-aid kind of a situation, and it will not solve the problem. So amongst the various options which existed,
I'll come back to you. Sorry to interrupt, Mr. Gupta. I'll come back to you for the options, really. Let me get in the others as well on this. Yes, Mr. Dua.
Just to answer the question you just raised by Mr. Gupta, our experience in raising the NRI bonds last time was far from happy. The cost of raising it, particularly in terms of hedging against the foreign currency, was huge, and some of the banks which were involved in the exercise will give evidence to that effect. That apart, I think the issue of NBFCs have actually, I would say, they have been, if I'm allowed to use the word, avarice or their greed, which has got them to this situation. When they found a lot of them who at one point of time were lending for infrastructure as well as construction, real estate, found that when the banks have stopped lending to them, they raised money from the banks, a short-term money, by offering fairly reasonable terms of borrowing. But in turn, the money which they raised from mutual funds and corporate bonds, those were in turn given to real estate infrastructure at a much higher cost, but much higher price, which got them a huge amount of leverage. But the money went exactly where it was not supposed to go.
Right.
And now if we see the real estate projects or infrastructure projects, if some of them which are being funded by visitors' money, those projects don't get completed, the problem of NPAs, of NBFCs would start becoming as prominent, as huge as we have seen in the context of banks. And I fear that that is where the issue, not just of liquidity, but also solvency problems will arise.
All right. Yes, Dr. Desai.
I would say that basically, in some ways, we have talked about this. Basically, they hit a sweet spot around 2016, partly because of demonetization, where there was a big flow of liquidity because money came into banks. And they made a lot of money. Many of these NBFCs in that period, they made a lot of money, 30% returns and so on. And that drove people to, tempted people into getting into this area. It was very easy money, as we just mentioned. The promoter's own capital was very small. He was living off large margins. between what the rate at which he was getting the money and the rate at which he was lending it. I use the word he because most of them were he's. But let's say this, that when we start looking ahead, this is a dimension that they should start tackling. Second, there are management issues. We haven't seen the full information on IL&FS. But I mean, look at the number of subsidiaries. It's amazing. How many is it? 100 plus? Some unbelievable number of 200 subsidiaries. And how do you manage with 200 subsidiaries with something like this? And somehow I've got hints, sufficient hints, that there was more to it than just liquidity crisis and so on. There were serious management problems. Should we have a separate window? We did have a separate window in 2008 for some financial institutions when we had to save them from the global crisis.
Yeah.
Is this a case for this? Or is the Reserve Bank right in saying OMOs are good enough? I think the next 2 months will tell us. My feeling is, given the liabilities which are going to arise, we are probably going to be forced into a special window.
Okay.
But then if we are going to be forced into a special window, then do something on the management side also.
Right.
No?
Okay, let's talk about the remedies now that Mr. Gupta was suggesting. Mr. Gupta, go ahead. What are the options really going forward?
Yeah. So one, I think, which SPI has already brought out, buying out, they've tripled their buyout portfolio for the year from 15,000 crores to 45,000 crores. So this will actually give money back into the NBFC, whereas the bank itself will not lose sight of the right kind of the credit that it will hold. They will get both. So both get the benefit. One gets the liquidity, the other gets to still hold the good quality assets. Now the other options clearly are actually based on the three most important things. One is, can equity be provided to any of the public sector banks, which are 21 in number or whatever? And this equity then can be used to actually give back loans, as I think the three formats in which it has already been described that the money can go to NBFC. One of them being the short term, which is the commercial paper, the second one being the lines of credit or the loans, and the third being again the buyout. So all three formats can be used. There is another option which is raise money internationally. The best source as of now, because of the global position, is exactly what we can start from, the NRIs. And given the NRI position, actually what has been tried, as somebody described earlier, was the deposit. The bonds have also been tried. And I think we will have to still go back and try one of that only. So amongst the various options that I could think of, these are the options, and I already listed the best choice out of them, according to me, remains the NRI bonds, which is what we'll have to try, and without losing time, because this is of a sense today.
All right.
So I will like to say that.
Yes, Mr. Dua, what is the solution really to the problem?
I think one is looking forward to getting the NBFCs under greater supervision of the Reserve Bank, because of the sector, as was mentioned by Mr. Desai, the NBFC sector has become huge. It cannot be left deregulated virtually as it is today. And that means things like capital adequacy ratio, SLR, CRR kind of requirements for them also to be made, so that we know that they are not lending beyond their means or dabbling in financial services like the way IL&FS we have seen seems to have happened. That's point number one. Second is, I would think what Reserve Bank did a couple of about 4 or 5 weeks ago. One, it said that lending by banks to a non-infra project could now go up from 10% to 15% of their capital. Probably, if for good projects, etc., this concession could also be made to NBFCs, and yet another concession which was extended to the banks when Mr. Urjit Patel talks of that he has taken adequate measures. He's including this probably as well, that the level 1 funding, it will include the government level 1 capital of the banks, will also include the government securities which they hold.
Right.
If these NBFCs are willing to subscribe to government securities, which are usually of long term, I think there is no reason why this treatment should not be given to them. But these are probably going forward. Immediate one is, please put on the table the money, as much money as you can bring in, and then we would see how much can come from the government banks or the private banks, and that as per the norm of the RPL.
All right. I think that's fair, and that's a fair way to go forward as well. You know, Subhomoy, what is the kind of impact that this crisis or this problem has on the allied sectors?
Quite a lot. Because practically there's, I was just trying to think that which are the sectors where the NBFC footprint isn't there, and frankly, there isn't.
There isn't.
And especially the manufacturing sector, that would take the brunt of it. The transport sector.
Real estate.
The real estate sector. These are the sectors which would get badly hit. So definitely you have a reason. Now, I'm not very sure whether bringing them into large rules exactly as the banks are would actually help, because in a sense then they would get trimmed the way. The reason why they were there in the first place is to ensure that they'd lend at easier rates than what the banks would be able to. But there's definitely no gainsaying the fact, both Mr. Desai said and Mr. Desai has also talked about the fact that that it should not turn into solvency issue, and for that the promoters have to put money on the table to make banks feel comfortable that what they're lending against is not a ghost entity, but an entity which has solid footprint and is willing to be there for the long term. Banks in the current stage will be very uncomfortable lending out without that sort of an assurance.
Right.
And I think that has to be made absolutely clear.
Right. Mr. Desai, close the show for us with your concluding remark on
yes,
what next for NBFCs really?
I would say, let's not just say all NBFCs. Technically, there are something like 10 or 11,000 NBFCs. But in fact, the Reserve Bank recognizes about 250 as systemically important. And I would say be realistic and recognize that your job, if you want to protect market conditions, is to worry about these 250. Don't mix up LIC and chit funds, for God's sake. Technically, LIC is an NBFC, and so is that chit fund, which my servant goes through for little things that they run. Now, technically, all of them are NBFCs, you see. But be realistic and don't worry about things like LIC. Those guys are not in trouble. Worry about those amongst these 250 systemically important ones who are likely to run into trouble because of these management issues, because of capital inadequacy issues, because of their exposure. And I would start looking at how rapidly they have grown. The risky ones are the ones which have probably grown too rapidly over the past 2 or 3 years.
So identify them.
Identify them and then focus on that. See whether you can handle it in informal ways, but be ready at some stage for creating a special window.
All right. I've got about 30 seconds left on the program. So, Mr. Dua, I'm going to let you close the show for us.
I think we have, I wouldn't say we have let a monster come up, but we now are talking about a sector which is as large as the banking sector and which has impacted, or which probably impacts a very large number of people. We certainly do need to do something for it, but while doing so, let's not let the past repeat itself, and that is where I say, in the name of flexibility, we allowed them in the past to have greater autonomy, not adhere to rules, but now please bring them under regulations, greater regulation. They need not be the banking regulation, but certainly they should not be allowed to have the free run they have had in the past.
I'm out of time, but I can see you putting up your hand there, Mr. Gupta. Go ahead. I'll let you have the last say.
Yeah, Frank, only one thing. See, while we are actually talking about the big NBFCs versus the small NBFC, we cannot forget the fact that IL&FS, till very recently, was the largest amongst the biggest ones.
Right.
And catering to one of the biggest sector, actually called the infrastructure. They were actually supposed to be one of the best managed, the best rated, and the best capitalized company in that sense, till all of the things came out in the open. So we'll have to watch all of them together and be worried about the sector as a whole. And I think that's what is important. So I think that's where we have to be very, very cautious about everything. and the liquidity has to be addressed. That's it.
All right, liquidity has to be addressed. We have to look at the sector on the whole is what the panelists are suggesting, and something needs to be done immediately as well. With that, it's a wrap on this edition of The Big Picture. Thank you to all my guests. See you again next time.